Hello and welcome to a very special edition of the FCMS Quarterly Market Review and Outlook. I'm Chief Growth Officer Stephen Watts with Founders Financial. And in just a few moments, you're going to be joined by President and Chief Investment Officer Peter Murphy. Pete's going to be walking you through all the market events that transpired in this past quarter. He'll also be sharing with you all the things you need to be mindful of as you go forward in the months ahead so you can guide clients and investors confidently. So without further ado, let's jump into it.
All right, looks like we're in good shape. So again, good afternoon or good morning, everyone, depending on where you are. It's Pete Murphy and Brian Zabora. And I'm going to go ahead and turn it back over to Brian and let him walk us through our market review.
Thanks, Pete. It's pretty crazy quarter. If you were off the grid for the quarter, you left on March 31st, came back June 30th. He's like, no big deal. But unfortunately, we all lived this roller coaster of a sharp decline in April, and then an unprecedented rally back to reaching all-time highs in July. So we'll start off with a chart on the next page of the S&P 500. This is year-to-date performance there in the middle there. And as you probably remember, we may want to forget, the market plummeted 19% roughly from the high in late February, early March to after the Liberation Day, when those tariffs were announced and they were more onerous than anticipated. We also had other kind of negative news, geopolitical issues with Iran. We had the U.S. government debt downgrade. So there was certainly several items that pressured markets or could have pressured markets. But equity markets climbed the proverbial wall of worry to finish the Q2 at record highs. The S&P rose 11% over the quarter, and then up 6% now for the first half of the year. And I want to kind of highlight why those markets rebounded. So one is Trump walked back the tariff implementation. There were a lot of delays, a lot of pauses. A lot of just pushing out. As you may have heard, there was one of the financial reporters termed it the taco trade. Trump always chickens out, meaning that he's not going to do damage to the economy and to the markets. There's a threshold that he's not willing to cross. Now we'll see if that continues, but that's what happened, at least in the kind of this early part of these announcements. Second, what we've seen is the employment data has been very steady. Jobs are still being added, not at the clip that we've seen maybe in 2024, but definitely positive trends as far as job ads. Unemployment is staying low at 4.1%. That's holding in better than I think people thought. Inflation is also starting to wane to a greater degree. CPI is still a little bit higher than the Fed would like, but it continues to decline. Tariffs have not impacted inflation to date. Again, that could happen, but so far so good. We're starting at a pretty good, an improving pace currently. Also, what we saw was corporate earnings for the first quarter came in pretty robust, double-digit growth, and that certainly helped the markets. And then also what we saw was the AI theme came back to light. There was some sell-off in the first quarter after DeepSeek was released, and there was concerns about AI spending. What did this all mean? But when companies reported, those AI adjacent or exposed companies reported good results, and you've seen Meta, Microsoft, NVIDIA all up double digits, up 20% year to date. So the AI theme kind of came back to the front in the second quarter. Moving to the next slide. I think this is the perfect example of what we saw as far as in the second quarter about the risk of being out of the market. You've probably seen this chart. It's from Bloomberg. It's from BlackRock. It shows you from a 20-year period, if you invested $100,000 in the S&P and just stayed and didn't move out of the market, you made that $100,000 was worth over $700,000. But if you had moved out of the market, if you just missed the 5 best days, that impact was significant. That $700,000 would be worth instead about $450,000. And if you missed just the 10 best days of that 20 period, it would be less than half. And I think this, important. You saw the V-shaped recovery in the S&P, and actually, April 9th, 2025 was a top 10 percentage increase in the S&P all time. The S&P was up 9.5%. So almost half of that rebound that you saw was all in one day. So again, I know it's something, that probably a lot of your clients are talking about getting out of the market, certainly concerns about Trump and what the economy meant. But staying in and staying the course certainly was the best result, certainly in this most recent sell-off. Moving to the next page, I want to give you a sense of how the U.S. market is stacked up against some of the international markets and bonds. As you know, international markets have performed very well this year. A big difference in the first quarter, where the S&P was down 4% and the MSCI World Index, excluding the U.S., was up 6%. That continued in the second quarter, certainly closer as far as the performance. But again, international, both developed international and emerging markets, outperformed the U.S. and now up almost 20% year to date compared to the S&P, still strong at 6%. Certainly, given the increase that we saw in 2023 and 2024, 6% at the mid-year mark, given some of those concerns that occurred or the announcements that happened, and so some of the risks in the market, I think is a pretty good result. But the international markets are way, way ahead. I'll get into the next slide about some of the reasons why. Bonds, I think it provided some good protection, up 2.8%, as you saw it as a ballast. Modest returns in this second quarter here, but 4% year to date, again, pretty good results. Yeah, so moving to the international stock performance for the first half of the year, I want to highlight some of the reasons why we've seen such a big rally. One is there's been positive economic surprises in Europe. The growth isn't great in Europe, but it's better. The trends are better than what we've seen maybe in 2024. So they're getting some positive economic surprises. Two, what we've seen is some more fiscal spending, especially in Germany. Germany has been very conservative, and if you look at their debt to GDP, it's very, very low. They're taking off that brake, and Germany is an important part of the European economy. So that could be that fiscal stimulus is definitely a positive. Also, unlike the U.S., where the Fed has stayed pat and hasn't cut rates yet, the ECB has been cutting rates pretty significantly over the last year. So that certainly has been lower rates. Interest rates have certainly been a positive for the equity markets. Four, valuations are much cheaper than the U.S. Now, the growth isn't as high, but given the outperformance of the U.S. compared to international markets for an extended period of time, that valuation gap has widened. It's narrowed a little bit. Valuation isn't the only reason to buy, but certainly there was an opportunity there to get cheaper valuations. And lastly, the dollar has depreciated significantly. It's been a big contributor to these gains. The dollar is down, as you see on the next slide here, down about 10% year to date. There's been a couple drivers for that. This is the worst performance, the S&P, as far as depreciation since 1973, as far as this 10% decline. There's a couple reasons. Tariffs, and while President Trump has not said this, come out directly and said this, the preference is to have a weak dollar. So that helps those domestic exporters with that weak dollar become more competitive. Again, hasn't stated it, but some of the policies are contributing to that. You're seeing these tariffs, which are contributing to the decline. Also, the deficit. There is certainly concern about the deficit and what that growing and what that could mean for interest rates in the U.S. And it certainly has contributed to that dollar declining. And also, there has been some talk about have international investors stayed out of the U.S. There's been different reports about that. There was a treasury auction where the international holders kind of boycotted to some degree. They came back in April, but that is also something to see that are some of investors shifting their assets out of the U.S. and into these international markets, which is also pressing the dollar. But that certainly is a big contributor to the equity international market gains. Moving back to the U.S. and taking a look at growth versus value. What we saw in the first quarter was, defensive stocks really outperformed. We saw investors with the uncertainty of tariffs and policy gravitate towards those consumer discretionaries, dividend paying companies, more stable earnings, and they really shunned the high growth technology sector really struggled. Certainly there's probably some profit sharing, profit taking in the first quarter from some of those technology shares, but also is concern of what was all these tariffs going to mean. And we saw a dramatic reversal here in the second quarter as these tariffs have been walked back. There's been basically a risk on attitude in the markets in the second quarter. So value stocks were up, but very up modestly. The Russell 1000 growth is technology led in the second quarter. Got back all their losses and some. So if you look at these two categories here after the second mid-year point, they're up both of about 6%. How they got there was completely different, with value stocks being pretty steady and then the wide swings. But certainly we wanted to highlight how this is shifted in the second quarter, and certainly it remains to be seen what we have going forward in the rest of the year. Moving to bonds and the performance there again, we highlighted this. Certainly, what was nice to see was in the first quarter that the bond served as a ballast, and you got a nice positive return when equity markets were down. Conversely, what we saw was investors getting more risk on. Certainly that hurt the bond market returns in the second quarter. The other consideration is we did see a wide range of results in the second quarter in fixed income, depending on what part of the segment you were invested in. Credit did very well. High yield and lower quality credits with the economy showing resiliency did very well and outperformed. Shorter term bonds did fairly well, with the expectation the Fed will be cutting eventually. That kind of belly of the curve, 2-year, 3-year, yields declined, prices were up. Conversely, if you look at the long end of the curve, where you think that where longer term macro and fiscal policy are more impactful, you saw yields fairly flat. Actually, yields were up on the long end, and prices fell if you looked at the 20 and 30 year. And that is that concern that we talked about with the big beautiful bill, that deficit spending is increasing. We're at a debt to GDP level that is we're at a high for a time where the economy is very good. But we've had other periods where during recessions or other periods where it's high, but this is unusual to see when the economy is strong and we're at this deficit level. So the question certainly becomes, if we do see a slowdown in the economy, what do these deficits look like? What do yields do? How is that going to impact the economy overall? So that is kind of a recap of the bond market, and just recapping everything here on our last slide summary. And despite all those newsworthy headlines, as far as all the negatives there, we're climbing the wall of worry. S&P was up 11%, now up 6% for the first half of the year. We're at record highs. International markets, strong outperformance. Dollar was a big part of that story. Not the entire story, but certainly a big part of it. Growth stocks, significantly outperformed value, and then fixed income, of course, underperformed in the second quarter, but have offered pretty steady returns. So that's the recap for the second quarter. I'm going to turn it over to Pete for the investment outlook.
Great. Thank you, Brian. And a shockingly good quarter. And if you haven't seen the video yet that Brian and I filmed earlier this week and sent out to you, we just speak about how unpredictable markets can be. In this case, if you just looked at the headlines, you'd imagine that the equity markets had tanked in the first quarter. And while they started pretty rocky and rough, to think that they were up double digits in the second quarter is something that few would have been predicting, certainly in the early stages of the quarter around all the tariff announcements. So really good opportunity for you all to educate through this experience, to talk about some of the dangers of market timing, as Brian highlighted. Using these real life examples is a pretty powerful tool to educate and reinstill discipline, long-term planning and focus and the like. and the markets gave us a great opportunity to do that in the second quarter. So I encourage you all, as you're having review meetings with your relationships through the remainder of the year, to not lose the opportunity, not just to reflect on how times are pretty good, and they are, as you saw, pretty much all asset classes are up, and up at a pretty healthy level in the first half of the year, but also some of the lessons learned for investors through the first half of the year is also a really important opportunity. So I'm going to shift gears now and switch the focus to a little bit more of our investment outlook and looking underneath the surface to some of the why of what's going on. So in many ways, when you look at the state of the markets today, there's this kind of disconnect when it seems like risk levels are very elevated. It feels like uncertainty is exceptionally high. There's geopolitical risk going on with wars between Russia and the Ukraine, and we've got issues in Iran and the Middle East, and ongoing conflict in those places. You've got talk about government debt sustainability, you have a debt downgrade. So there's a lot of negative news headlines. And how do you square that as an investor with most global equity markets are sitting at or near record high levels, both in the US and overseas? And it seems like an unusual combination. And so when we look a little bit deeper and trying to understand why and how, a few things stand out to us around more of the fundamentals that maybe they don't get the headlines because they're just not as exciting and newsworthy, but they're actually the most important thing. And despite all of the noise and activity going on in the world, geopolitically, economically, you name it, overall, the US economy remains resilient. And you continue to hear us talk about this. You're probably at this point a bit bored of hearing us talk about resilience, but there was pretty widespread calls that the US economy was going to enter a recession in around 2022. And growth certainly slowed down. It even declined modestly a couple quarters, but we never went into real recessionary conditions with big layoffs and big corporate defaults in the debt markets and things like that. It just never happened. And what's been consistent through this period of the last couple of years is, one, the equity markets have been exceptionally strong. And we talked about that, the strength in the market 2023, 2024, and now even surprisingly 2025. Despite a rocky start, we're back up again and we're up meaningfully. And so the equity markets have been strong, but the economy has been equally strong in terms of the levels of economic growth. And you can see in this chart on the left, this is looking at real GDP growth, so inflation-adjusted growth in gross domestic product. And you can see as the trend line has been at about a 2% growth rate real, which has been a pretty consistent rate. And you can see while during the pandemic, we kind of sharply fell down, that's that big blip down you see. The economy really quickly recovered from that, got back to trend growth, and we're even growing a bit above trend growth of late. So this story of all of the headwinds and all of the economic challenges and all the geopolitical challenge belies the fact that the underlying economy has been chugging along pretty nicely. And then probably even more importantly for investors is corporate earnings, because in the stock market, we're investing in businesses. And businesses have proven even more than resilient through the last couple of years. So despite all the challenges from the pandemic, despite all the challenges from the inflation shock, despite the challenges from tariffs and geopolitical risk, you see profit margins on S&P 500 companies pretty close to record levels, and they've been rising pretty strongly off the lows that happened back in 2022. And so, excuse me, we've got this strength in the US economy that's also translating to strength in corporate earnings, which is a pretty promising combination when you look at asset prices. And most measures in the US economy are pretty healthy. Brian mentioned earlier, the job market is in a pretty solid place. We're not seeing significant growth in jobs, but we're seeing steady growth in jobs. And we're certainly not seeing significant levels of layoffs. The unemployment rate remains very low. When we look at consumer spending, it just continues to chug along. And consumers are doing pretty well. And when people have jobs, they tend to spend. And a healthy job market tends to translate to healthy consumers. And so consumers seem to have weathered the inflation shock and are continuing to spend. And as we all know, that's incredibly important because consumption represents close to 70% of economic activity in the US. So this picture of economic resilience has been a big part of the equity market gains and the record highs we're seeing in many equity market indices. The second notable trend that's getting a lot less airtime these days, although it got all the airtime the last couple of years, is inflation. So you can see in this chart, we had the big spike in the rate of inflation to almost double-digit levels in 2022, and it's just steadily declined back down, and it's pretty close to the 2% target, which is that black dotted line you see there. So inflation has stabilized, and that's been a very important trend and factor for markets because stable inflation allows a lot of things to happen more easily. It makes it easier for central banks to lower interest rates. It makes it easier for businesses to make plans about the future. It makes it easier for lenders to make decisions to lend when there's stability in prices. When there's not stability in prices like we saw in 2022, a lot of things can seize up because of the uncertainty introduced by rising price pressures, and a lot of that uncertainty has subsided. Now, I don't mean to say here that prices have come down to where they were before that spike. They haven't. They rose to a new level and continued growing. But what matters here for investors is the trend. And the trend is back toward and pretty close to target. But the more important trend is how you see that line is kind of stabilized from that spike we saw back a couple of years ago. So what this is allowed for, it's allowed for central banks to begin easing monetary policy. And easing monetary policy generally comes in the form of lower interest rates. And lower interest rates tend to be an accelerant to asset prices. And that's exactly what we've seen in financial markets this year. So while the Fed has actually not been cutting rates this year, they did a little bit last year and then paused because of a lot of the uncertainty around tariffs and the potential impact on inflation and growth that was uncertain. A lot of other central banks around the world have been cutting interest rates consistently through this year, most notably the European Central Bank. And it's not surprising that as some of those overseas central banks have started cutting rates, you've actually seen their markets outperform. And so you're seeing that liquidity infusion from central banks through easier monetary policy translate to higher asset prices, and expectations of that in the US, the Fed is expected to begin cutting rates again sometime later this year if conditions continue on the current trend, is also looking forward to that as well, which may be a further case for more accelerant into asset prices and markets as we move into the second half of the year. So inflation is the second big factor in how it's moderated and been decelerating. And then the third is all of this was all over the headlines, but I think the subtle shift under the surface was more important than many likely give it credit for. In the early part of the second quarter, all that investors were focused on and all that the financial media talked about was tariffs. That absolutely dominated the headlines because that was where all the newsworthy activity was. And that's really what drove the sharp sell-off in markets in the first few weeks of the quarter. But what happened is, as the tariff risk receded, and as concerns around tariff policy receded, it doesn't mean it disappeared. It just means people became more comfortable with the tariffs and the policies and became more confident that draconian measures weren't going to be maintained beyond what was reasonable from an economic standpoint in terms of its impact on growth, inflation, and employment. And as people became less worried about tariffs, the focus shifted towards the tax and spending policy and the big beautiful bill. And so what that means, and there's all sorts of dynamics at play with this bill, and we're not going to get into them today, but why this shift in attention from investors and markets mattered is tariffs was all about how's it going to disrupt businesses? How's it going to reduce margins? How's it going to increase inflation and price pressures? The bill and the focus on the bill, especially in the early years, is around tax cuts and fiscal spending, both of which are likely to actually boost growth to some degree in the near term. Now, it obviously comes with bigger deficits and more debt long term, which has been a theme for administration after administration for the past 20 to 30 years now. But in the near term, it's actually likely to increase growth to some degree. So all three of those factors, a resilient economy from a fundamental standpoint, coupled with moderating inflation and easing monetary policy from many central banks, and then a shift from a focus from tariffs to tax cuts and spending, really all combined to create a really good quarter for financial markets. And as you saw, equity markets in both the US and overseas were up double digits last quarter, which is pretty amazing if you think of the starting conditions. So with that rosy picture, it doesn't mean that everything is perfect and there's nothing to worry about. As you all know, risk is ever present. It's just around when those risks materialize and how markets are priced relative to the risks that are out there. So this is all an exercise in probability, but we are always thinking about what should we be monitoring and what should we potentially be concerned about as we look forward to the second half of the year. So the first is probably not a surprise to any of you. And as I said earlier, while concerns about tariffs have receded massively since 90 days ago, tariff policy remains a wild card and a great source of uncertainty for investors. And we're seeing it again this week with tariffs of 50% announced on certain countries and on certain materials and the like. So tariffs have obviously become a negotiating tool and a political tool as opposed to just an economic tool at this point. And so it's going to continue to create uncertainty in the context of financial markets and the global economy. But what you're seeing is these announcements are met with less and less movement in market prices and financial asset prices because investors have grown accustomed to the announcements, the eventual delays and rollbacks, and they're used to them. So this is something that is almost impossible to predict. We just know it's going to remain present, and it's something that we're monitoring closely. We're not using this to make really active asset allocation decisions and the like, because we don't think that's something that can really be done effectively. But we're also staying diversified and keeping risk management at the fore, because this is kind of an ever-present wild card and risk that we just can't really quantify, and it could change on a dime. And if you look at this chart, even with where tariff rates are now, with the delay of all the reciprocal tariffs and then not going back into effect, tariff rate has gone from a couple percent up to almost 15%. That's the highest in almost 100 years. So tariffs have definitely increased materially. So far, businesses and the economy seem to have weathered that increase, but it's still early. And there's still a lot to be written in terms of how long the effect of the tariffs take to actually play out and what the ultimate impact will be. So we're going to continue to monitor this, because this story, we don't think it's over yet. And what's most important is, what are the longer term impacts that this uncertainty and increase in tariff policy will create for economic growth and for corporate earnings? So something that we're going to keep watching. The next is also something Brian mentioned, but this is a much more consequential long-term risk. And it's been brought to the fore again, largely because of the combination of Moody's downgrading the US government debt from AAA, alongside the expansion of deficit and debt from the bill that just passed through Congress. And so when we look at fiscal deficits, debt, and the potential impact on interest rates, this is likely the most consequential risk for investors looking out over the next 3 to 5 years. The challenge is that these trends have been in place for a long, long time, and there have been many false alarms around this risk coming to a head and causing meaningful challenge within financial markets. So we're cognizant of trying to time this risk is something that has proven very difficult to do. And much like economists have called 10 of the last 2 recessions, similarly here, economists have called for 10 of the last 2 government debt crises, and they just haven't happened yet. At some point, things will reach a tipping point. There's a lot of research around when that will be, what that will be, but there's no doubt that the trend is higher in the context of deficits, in the context of debt, and that at some point we're gonna cross that tipping point, and we're closer today than we were 5 years ago, 10 years ago, 20 years ago, et cetera. So we're monitoring this closely. These slides help put into context for you where these levels are relative to history. So if you look on the left-hand side, this is the level of U.S. federal government debt, and it incorporates the passage of the big beautiful bill, and then a few other assumptions around interest rates and how they change over the course of time. But what matters here is if you look at the level of U.S. government debt relative to the size of our economy as measured by GDP, we're about at 100% today. If you look at that chart, the last time we were anywhere close to these levels was after World War II. And so if you think about where we are today as a country compared to where we were during World War II, these are pretty staggering numbers in terms of the size of debt relative to the size of our economy. Obviously, our economy is a lot bigger, but our debt's also a lot bigger. And so that is something that at some point you realize it's going to reach a breaking point. And what we've seen happen since the financial crisis about 15 years ago was during the financial crisis, a lot of households and businesses delevered when we had the mortgage crisis and the housing crisis. So that's when households did a lot of deleveraging, declaring bankruptcies, kind of clearing the system. Businesses did the same thing with the rising defaults and the like. And what happened in the wake of that is the government stepped in and did a lot of spending to kind of pull the economy out of that. And it's led to increased deficits and debt, but they never turned the spigot off. It just kept rising and kept going. And so with that, we're now reaching levels that are pretty dramatic. And couple that with now we're seeing interest rates rising from the really low levels that were in place last decade. And so all of a sudden, interest expense is becoming something that is consequential in the context of the government budget and government debt. And you can see here in this chart on the right side, this is looking at interest payments as a percent of GDP. And not surprisingly, once again, we're up north of 3% on this, which is the levels we were back in the 90s before we had the last kind of reset in debt when President Clinton was in office. And we actually moved into a budget surplus for a short period of time around that. So is this going to be the wake-up call? Have we crossed the threshold? I don't know. Time will tell. But it's a pretty material increase when less than 10 years ago, we were spending about 1.3% of GDP on interest to today, we're spending north of 3%. So a very dramatic shift. And this is a risk factor that we're going to be monitoring more and more closely. Our team is doing more research on this than ever to understand the implications for investors and how we need to potentially prepare and adjust portfolios as these circumstances evolve. And then the next slide is a slide about valuation. And we haven't talked a lot about this. Brian mentioned it some, but when you've got markets at record highs and you've got a lot of these kind of unknown risk factors out there, part of the question is, well, how are markets priced relative to the risks? And when you look at stock market valuations today, and I'm going to focus on the S&P 500 here, they're very, very high. So the S&P 500 is trading at almost 22 times forward earnings. To put that in context, the only time in the last 50 years that we've been higher than this is at the peak of the technology bubble in 2000 and back at the peak of the market in 2021. So markets today are not cheap. It doesn't mean that they're imminently going to crash. But what it does mean is that if some of the positive factors I spoke about a few minutes ago start to trend in the other direction and investors start to take notice of that, there's probably a lot of room for markets to fall, especially U.S. equity markets, which are relatively more expensive. But it's the same story overseas. While they're relatively cheaper than U.S. markets, they're not absolutely at exceptionally cheap levels. So this is something just to keep in mind, that markets are trading at a pretty healthy multiple today. So there's not a whole lot of risk premium being priced into equity markets today, especially in the U.S. And then the last risk factor is a source of uncertainty that everybody knows is on the radar, but nobody knows quite what's going to happen, and that's around the Federal Reserve. So President Trump has been overtly calling for the Fed to cut interest rates. He's been calling out Chairman Powell pretty consistently and increasingly of late. And that's something where the independence of the Fed and being able to operate monetary policy independently, it has been one of the sources of strength within the U.S. monetary system and policy. It's why the dollar has been strong for so long, even though of late it's changed course. This is probably another reason why we've seen some of the weakness in the dollar is some of this kind of shift around it. So there's a lot to be written here. Chairman Powell's term as Fed chair ends next year, so there will be a change here, and President Trump will appoint the next Fed chair. But it just introduces another set of dynamics and uncertainty that markets are going to have to digest. Doesn't mean that it's going to transpire in a negative direction. It's just another source of unknown that is going to be playing out over the next probably 6 to 9 months. We'll have a lot more clarity on this point. So the Fed, who has kind of taken a backseat to tariffs and spending bills in the first half of the year, is likely to be back on center stage again as they prepare to begin cutting interest rates again, and as the political pressure ramps up because the government is wanting lower interest rates to fund these increased deficits based on the bill that just passed. And so you've got this interesting dynamic at play. So a lot more to write and to see with this, and we'll probably be speaking about this in much more detail over the course of the second half of this year. So just to summarize, first and foremost, stock markets around the world, many of them are at record highs. And the reason for that is the fundamentals today remain pretty resilient. So the US economy remains resilient, labor market's healthy, consumer spending continues to be solid and stable, and corporate earnings continue to grow and margins are high. So kind of that fundamental cocktail remains in place and is a good trend. The moderation of inflation has been meaningful from the spike a few years ago. So we're getting very close here in the US to 2% inflation. Europe is pretty much already there. And that's given central banks a lot more flexibility to ease monetary and to increase liquidity in the markets and economy. That tends to be a good environment for asset prices. And we've seen it being a good environment for asset prices, especially in the second quarter. And then, as I spoke about again, the spotlight shifted from tariffs to tax cuts and fiscal spending. So now that the bill has passed, the investors will likely shift focus again to something new in the second half of the year, and we'll see what that ends up being. But for the second quarter in the near term, that shift in focus has been a positive for financial asset prices. And then turn into the risks that we're focused on and monitoring in the second half of the year and beyond. The first is tariff policy, which remains a wild card that is going to remain out there for the foreseeable future. I talked about the longer term challenges around US fiscal deficits, debt, and interest rates. That is becoming increasingly top of mind or front of mind for investors, and something that we're going to be watching very closely in the months and years ahead. I spoke about the relatively elevated valuation levels of US stock markets, but also stock markets globally as well. US just stands out in terms of its level of valuation compared to others. And then finally, the uncertainty around the Fed, with the pressure from President Trump to lower interest rates alongside a change in chairman coming next year. So that wraps up our prepared remarks for today. So enjoy the rest of your summers with your families. Take care.
And that concludes today's special presentation of the FCMS Quarterly Market Review and Outlook. Thank you all again for joining us. If you want to learn more about FCMS and the services we provide, please visit us at foundersfinancial.com. We look forward to seeing you in the next presentation. Have a good day.